It's great to be here this afternoon. I'm pleased to join the conference. It sounds like you've had a great time so far, and I hope that I will continue that trend. I should make it clear, just to pick up the points that Adrian's just made, that my comments this afternoon are personal. They don't represent the interests of either Nest or the FSA. I work at CAS with Professor David Blake, and we've been working for some time on looking at how retirees should spend their savings optimally through retirement. And we published a working paper towards the back end of last year, and I was asked to come along and make a few comments around that this afternoon. Our aim has been to really sort of look at how rational pensioners would optimize their financial plans and then find ways to nudge them into making sure that they use those optimal decisions. We do this by introducing what we call a speedometer retirement expenditure plan. It's designed to help pensioners spend their money optimally through retirement. And we've used speedometer basically because it reflects the fact that spending optimally is related to speed, and that actually, if you think about the driving connotations, the speedometer is also supposed to be a useful device both for measuring and influencing the speed at which you drive, and the same needs to apply in retirement. We believe the timing is right to start to share our thinking, given the point that Adrian just made, that the governments have made the decision to remove compulsory annuitisation. And I think pensioners already have a poor perception of annuities, and there is a risk and an unintended consequence of the government's latest proposals that they'll see annuities as inferior contracts that certainly the less well-off are forced to buy. And I think that would be very unfortunate, and we need to do something about that. I propose to structure my session as follows. I'll start by looking at needs, risks, and financial resources. Then I'm going to say a bit about optimal solutions, but optimal solutions for different market segments, considering how each of those segments can behave optimally and how they should manage their investments and the income that they draw down during retirement. And then, having determined what the optimal plans are, I'm going to look at the behavioural constraints which maybe will stop people getting to those optimal plans, and finally look at, to use the in word, how we might nudge people to actually follow the best route for themselves. Let me just start with looking at needs. It's obviously important in determining optimal strategy to focus on retirees' needs and the risks that they face through retirement and the financial resources that they're going to have. We have to do things holistically here. Consumption needs in retirement are neither smooth nor certain. Expenditure in retirement typically exhibits a U-shaped pattern, and I tend to use very simple charts, so here's a simple U-shape. First, there's a period of active retirement in which retirees do the things they promised themselves that they would do, but did not have the time to do while they're working. Then we enter a period of relatively inaccurate retirement, where the aches and pains of life become more prominent, and eventually people probably can't even go out and buy the newspaper there. And then finally, for many people, sadly, we get to the point where they're into a nursing home, and expenses particularly tend to rise very rapidly. For some people, maximising inheritance is also obviously an important feature. The analogy I like to use on these things is that pensioners live in an uncertain world, and to some extent, many of the events that can impact them can impact a well-structured retirement plan because they are essentially random, or at least they will happen, but we don't know when they're going to happen. And to a certain extent, I think it's very much like the game of snakes and ladders, or could be like the game of snakes and ladders that we played in our childhoods, or certainly I played in my childhoods. Most of you are young enough to play computer games, I guess. But you know, the sad fact of life is that there are many more snakes than there are ladders. And I think given the time pressures we're under, I'll leave you to study this slide at your leisure later, and hopefully you'll find that the lists here are self-explanatory. Of course, the analogy to snakes and ladders is not quite right. Snakes and ladders is essentially a random game. You have very limited tactical or strategic options. You know, if you throw a 5 and you land on a snake, you land on a snake. And therefore, there's limited opportunity to mitigate the impact of landing on a snake. However, I believe that with retirement planning, pensioners can be helped by advisors to prepare in advance to mitigate the impacts of many of the shocks. And in real life, sadly, particularly for, or perhaps not particularly for the annuity companies, but sadly you can't land on a snake at age 99 and move back to age 85. I think those of us who are involved in predicting longevity would find that very difficult. Looking on to what resources we've got, many of the baby boomers approaching retirement in the UK have been fortunate enough to actually accumulate a significant amount of wealth. You probably wouldn't believe this when you read the newspapers, and that's happened through house purchase and defined benefit pension plans. There's 7 million people are aged between 55 and 64 in the UK, and they essentially represent the first wave of the baby boomers. And they've accumulated £2.5 trillion worth of wealth, including 1.2 trillion of pensions wealth. And I find it actually quite interesting to see that nearly half of that is already pension in payment. A lot of people have taken their pensions earlier than when they're retiring. And this pension figure excludes the state pension, but does include an allowance for unfunded public sector pensions. There's also £900 billion worth of housing wealth, £265 billion of financial wealth, that's the net cash and liquid assets excluding pensions, and there's £208 billion of physical wealth, which is people's like cars, people's possessions, and so on. As you might expect, this wealth profile of the baby boomers follows the classic 80-20 rule, 20% of the population having around 80% of the wealth. If we look at the 2006 FSA baseline survey, and we look at people over 50 who have yet to retire, we can segment the market into three groups. Some 3 million people who have minimal wealth, 4 million who I will call the mass market, representing about 45% of the population, and there's 1.8 million, the 20% I talked about before, who are in the mass affluent and the high net worth area. Of course, most of this final group will have significant housing wealth and pensions wealth, and their typical wealth as they approach retirement is going to be £1 million or more. And therefore, that gives a great opportunity for the life industry, as I'm sure you've been discussing over the past day and a half. And it's here that we need to employ a holistic strategy. So if I move on quickly, because I'm supposed to be talking about behavioural economics, so I'm sort of covering the ground quite rapidly at this stage. If we look at the optimal solutions and we look at what this means for pensioners, sadly, for the low-income and wealth retirees who have very little savings and probably didn't even buy their council house or whatever, they'll continue to be very reliant on state support throughout their retirement. For those who are in the mass market, early annuitisation is still likely to be the best option. Most mass market pensioners have still relatively limited means and therefore cannot afford to take a lot of risk with the small amount of pension savings that they have. As a consequence, mass market households are likely to have to accept a relatively simple strategy, and their primary focus will be on maximising their retirement income. A level annuity may well be appropriate for this group, particularly given the latest government policy of having a three-tiered protection of the basic state pension, which for this group is typically about 80% of all of their retirement income. The mass markets are therefore probably going to have to rely still on the state, and then if they have any housing equity, for providing for health care and other retirement contingencies. And bequests, I think it's fair to say, will mainly be in the form of residential housing equity, and will typically be left more by chance than design. If we move on to the mass affluent, the position is very different for those with wealth. It's a big challenge to optimise the controlled rundown of a pensioner's assets throughout their retirement, particularly for pensioners in their 60s who are looking to retirements of 20 years or more. Investment strategy is far more complex in decumulation than it is in accumulation. Lifespans are uncertain, so you don't know how long to spread the money over. And if income has to be withdrawn when fund values are depressed, that can have a dramatic impact on future income because there isn't the opportunity to recover from mean reversion and so on. You don't get the benefit of pound cost averaging in decumulation. You get the reverse. And again, unlike the mass market, who can rely on the majority of their income being inflation-proofed by the state, the mass affluent have to really worry about inflation. That's going to be the thing that's going to worry them the most, and the current high inflation rates are likely to bring that to the fore in their thinking. Given the considerable doubt and uncertainty in the early years of retirement, it generally makes sense for the mass affluent and pensioners to retain as much flexibility as possible and to retain control over their assets. Pensioners should look to secure a base income and then use insurance solutions where they're available to reduce uncertainty from adverse effects. But in a number of cases, the insurance propositions sadly don't represent necessarily the most cost-effective way of working. Annuities should have a role to play in securing lifetime income and inheritance tax planning, and they reduce the variability of the amount of inheritance that people can be left. So to my mind, it's not a question of if, but when people should annuitize. But I would say that for single retirees, the work that I've been doing, and I'm writing a paper on this at the moment, it suggests that it would probably make sense for people who are single to phase the purchase of annuities during their 70s, and for couples to be annuitizing at an even later date than that. As life expectancy reduces for the mass affluent, the optimization task actually becomes a little bit easy because there are fewer risks to cater for. As life expectancy reduces, investment considerations become clearer as bonds and cash become the sort of the optimal holding. And once we get to that point with bonds as the optimal holding, it really makes sense for people to be buying annuities. Not only because they provide insurance against living too long, but they also provide cover against the retiree from credit risk and default risk. Also, when people go into a nursing home, expenditure becomes less volatile and more predictable. Overall, there is a narrowing funnel of doubt based on life expectancy, so we expect our flexible optimization strategy to look something like this chart, which indicates the use of more flexible products initially, as you can see there, drawdown with profits and so on. But as we get towards the end, more use of pension annuities, purchase life annuities, immediate needs annuities, and potentially equity release for paying for long-term care. So let me move on to the behavioural barriers. I've suggested what retirees might do if they were behaving optimally, but there's a lot of evidence to indicate that people do not behave optimally, especially when annuitization is not compulsory. Evidence from the US is that retirees do not annuitize sufficiently to protect themselves from outliving their resources, and hence there's a lot of work at the moment being done in the US about auto-enrolling 401k retirees into lifetime annuities, almost the total opposite of what we've got here. Economists call this reluctance to annuitize the annuity puzzle. Behavioral economics combines economics, finance, psychology, and sociology. Behavioral economists have demonstrated some of the limitations of standard economic theory caused by the failure to take human behavior into account, and I'll give some examples of that in a moment. Dick Thaler and Cass Sunstein produced a best-selling book, Nudge, Improving Decisions About Health, Wealth, and Happiness, and they define two very different types of people. They define econs, who are highly rational consumers, capable of fully understanding the complex sets of choices that they're faced with in, say, retirement planning, and having the skills to make decisions that will improve their current and future welfare and happiness. Now, that's most of the people in this room would be econs, but sadly, most of the rest of the population are humans. Humans, by contrast, try to plan ahead, intend to make the best decisions for themselves, but they're subject to behavioral traits that limit the ability to implement their plans. This is particularly true when it comes to implementing long-term plans, such as planning spending through retirement. Thaler and Sunstein believe that there are actually very few people that are econs, and hence the importance of their book and nudging people to do the right things. Humans experience a number of behavioural traits and influences that limit their ability to make rational decisions. So we start by looking at choice, and this leads to inertia and procrastination. Traditionally, economists would argue that the more choice, the better, because it would allow an econ to absolutely optimize their choices and make sure they made the best decisions for themselves. But actually giving people too much choice can result in poor decisions being made because people rely on crude rules of thumb, it gets too complicated for them, and they can even have a tendency to put making off a decision at all. When it comes to planning their finances through retirement, humans have a large number of aversions. We start with an aversion to both planning, particularly planning large long-term transactions. So buying a house and buying an annuity are really the things that would frighten people most. And they also have an aversion to losing control, and again, that applies to annuities. People also have an aversion to dealing with complex problems, and as well as facing reality when they're faced with inadequate savings. People tend to assume the best is going to happen and that freeze in the headlights. Again, related to this aversion, there's an aversion to paying for advice. And interestingly, just as an aside, the Consumer Financial Education Body, now called Money Advice Service, have found, though, that people who pay for advice actually are more likely to actually take account of it. Many people appear to regret making losses far more than they have gains. And it's been shown that in terms of the brain's reaction, typically a loss counts as twice as much as a gain. Then we've got the issue that the way in which we frame things and the way in which people react to the herd and to the norm can have a big impact on the way that they operate. Choices can be framed either intentionally or unintentionally in a way that causes people to choose one option over another. In addition to framing, retirees can also be influenced by the herd and the norms, even when this is not rational. For example, I'm very concerned about the negative impression of annuities. And I've always found it somewhat strange that pensioners like deferred benefit pensions and yet feel really that annuities are robbery. When the loss on, in a DB scheme, the loss on early death is just as bad as it is under an annuity. And you can't even get ill health pensions from your DB scheme. Very interesting. And then we get to the point which is where some people are allowed to switch off, particularly in the first session after lunch, but it's the sort of technical bit. I mean, what the behavioural economists have found is that people tend to use a very high rate of discount when they're valuing future amounts of money. What behavioural economists call hyperbolic discounting. The theory sort of suggests that our brains have a very high mental discount rate, probably around about 20%, and that means that people tend to overvalue the present and undervalue the future. And hence, for example, that would explain why people tend to go for a lifetime annuity, a fixed lifetime annuity, rather than an escalating annuity, because they can't see the value of the escalation or the RPI benefit. Humans also tend to overestimate the likelihood of low probability events, and they tend to underestimate the likelihood of high probability events. And again, sadly, annuities demonstrate this very well. The pensioners considering buying an annuity, they tend to worry very much about what's going to happen if I die early. There's probably only a 5% chance at most that they're going to die within the first 5 years, and yet they underestimate the chances of living beyond their life expectancy, and yet half the people are going to live beyond their life expectancy. All this leads to overconfidence and self-control problems, and to humans having a tendency to overconsume today, jam today rather than jam tomorrow, and so face the possibility of running out of money in retirement. Humans fail to plan and even if they do, they often fail to follow through in terms of taking the necessary actions. Humans have no sense that an annuity is a smart thing to buy. All in all, this leads to suboptimal decisions, and as you probably have guessed by now, we need to make sure we nudge people through to that. So this brings us on to the sort of what people would call the choice architecture and nudges. If we return again to Thaler and Sunstein's distinction between econs and humans, we need clearly to accept that most people are humans. We should therefore recognize that the retirement stage of a pension plan is just too complex for most people to deal with without an outside influence. We therefore need to develop a good choice architecture and combine this with good nudges. And this is where our speedometer retirement expenditure plan comes in. As we've seen, we need to recognize that retirees have different expenditure needs during the phases of retirement. They need to pace their spending throughout retirement in order to optimize the use of their financial resources, as Adrian said at the outset. And they need a sound choice architecture that reflects the market segment to which they belong, and therefore the capacity and the ability to take and absorb risk. Bearing all these considerations in mind, we've developed a 5-stage plan, and I'll just say a few words about each of those stages. The first stage is that you need to make a plan, and that's easier to say than to achieve. But ideally, if wealth permits, this should involve a financial advisor whose role is to assist with making and implementing the plan and conducting annual reviews. The advisor has the key role to reinforce the messages and the nudges as they go through. And there are analogies here with personal coaches in gyms or with dieting using Weight Watchers. For those who cannot afford or are unwilling to use an advisor, the fallback will need to be some form of online or telephone-based service providing generic financial advice, such as the money advice service. We think that we're going to have to find a way to auto-enroll people into some form of a plan like this to make sure that they do actually get and build through the way that they're doing this. It's important that the planning does take place in the run-up to retirement, and in a sense, the plan is the key thing that happens. People need to have a plan. And the remaining steps essentially implement that plan. The plan needs to take a holistic approach with the aim of securing, in the first instance, a minimum core inflation-protected income, which will obviously be helped by the £140 basic state pension, even when it comes in. The third stage would be for people to buy their insurance to cover rainy day funds, to cover contingencies, but only if we've got cost-effective insurance to do that. Some expenditures in retirement are very lumpy, and that's why insurance should be helpful. And the lower less insurance people take, the higher the rainy day fund needs to be retained. Care costs are potentially the greatest spike to expenditure, and that's an area which I know is being reviewed by government at the moment. The fourth stage is around securing an adequate income. Many people will want to secure an income below the essential level, and especially if they have the resources to do that, to have the safety and the satisfaction of knowing that that's there, whatever happens. And this is where further annuitization will take place, probably as people are into their 70s. And then for those that have got enough wealth, essentially you move on to making sure that these people achieve a desired standard of living that makes the plan successful and one that will still use some default options for investments, but in particular will have phased annuitization and the use of annuitization as well in the form of purchase life annuities and whatever, to make sure that money can be given away at the right time to avoid inheritance tax and so forth. So just to pull all this together, the speedometer plan deals with the behavioural traits I outlined earlier. Critically, the plan uses inertia and procrastination, since once auto-enrolled, individuals don't tend to change their minds. Equally important, the plan uses defaults for the mass market and advice as the key nudge for the mass affluent. Speedometer plans, to be effective, they need to comprise a small set of well-designed default options with flexibility to change the default as and when the advisor identifies a need to do so. Crucially, it's the plan which deals with the complexity of decumulation and decision-making, not the member. I think by having a good plan, we're in a much better position. And that, in a sense, bypasses some of the problems that we have with poor financial literacy and planning aversion and poor understanding of longevity risk. The plan accepts that individuals will suffer from overconfidence and have self-control and hyperbolic discounting problems and will benefit from using commitment devices. The use of capital-protected annuities, or as I like to call them, money-back annuities, deals with the aversion of losing control and the fear of the loss of capital, and phasing also helps with that. And gets over the sort of the issue around large transactions and the possible regret about buying an annuity. Except for plan members who reveal themselves to be extremely risk-averse, the annuity will not be the most prominent feature in the early years for the mass affluent. That will come later. Annuities will be one component, and research has shown that if people buy an annuity in their 60s, they're much more likely to want to buy another one in their 70s if they've got the money to do so, because they understand the value of that. Having dealt with the design, the important feature of the speedometer plans is making sure that we get to a point of making sure that people feel that an annuity is a smart thing to buy. Buying an annuity needs to become the thing that's viewed as being smart. It needs to become the thing that people are actually quite proud to say in the pub that they've bought an annuity. It needs to become the norm, a norm that retirees will feel very comfortable with because they understand that buying an annuity, they can spend safely today, knowing that they're not going to run out of money. A speedometer plan with its optimal use of annuitization allows retirees to spend more today, safe in the knowledge that they'll be able to continue their lives to the full, however long they may live. And I hope you found that of some interest. If you have, there's a paper that you can look at and a reference there on the internet if you want to find out a bit more. So thanks very much for your attention. I think we'll...
Thank you, Tom. Do hold on there at the podium, because it's a good place to take a question or two from. I have to say, as an annuity provider, I'm delighted to hear that the research shows that having bought one of our products, people come back and want to buy another one. That's exactly where providers of anything like to be. So that is super-duper news. We've got time for a couple of questions for Tom, and I have one over there in the middle in the white shirt, please.
Tom, is there a level of wealth where you would feel that buying an annuity isn't really a sensible part of an income management plan?
Essentially, the answer to that would have to be yes. I think, having said that, though, I think that you're probably talking about the very wealthy, because I think that even people who are quite well off have an uncertainty as to how long they might have to live in a nursing home and plans there. And you are, in a sense, gambling away. You're gambling with the inheritance that they may want to live to their children. I think that there is a bigger role to play for annuitization in terms of inheritance tax planning to secure the income that's going to be required for people for the rest of their life, so they can actually start to give their money away perhaps 7 years before they're going to die, and whatever. And I think we've missed a bit of a trick around that. I mean, I'm lucky enough to play golf with a guy who used to be at Standard Life and is now a very good IFA, or at least I think he's a very good IFA. He sells quite a lot of purchased life annuities, and I was amazed to look at the ABI statistics and see that there's less than 1,000 purchased life annuities being bought at the moment. And yet I think he's doing a really quite a good job with retirement planning and helping people do that by getting the yield up on people's assets.
And I've got another one here, again in the middle towards the front, please. The microphone is on its way through a circuitous route, so making its way through the packed auditorium to you.
Hi, Tom. Deepak from Tata Consultancy. I think, since yesterday, I mean, there has been a recurrent theme about engaging the customers, about customer engagement. And I think nudge, what you talked about, is very much, part of that whole engagement. The question which I have is, who administers that nudge? Is it the IFAs? Is it the providers? Because we've already seen that the overall engagement level is very low, and so is the trust level. So if, let's say, if a nudge is administered by a IFA, what is the uptake of that nudge, or even the provider?
Well, I think this essentially is the challenge of what we're saying here. That, in our sense, I think the most important nudge of all in the retirement space is to get somebody to talk to. If they've got enough wealth, is to get those people to talk to an advisor. That is the most thing. If you can get people to talk to an advisor who are then going to help them plan their money through retirement and do the plan and come back and keep them on track, that actually is, we're where we want to be. This is too complicated for people to do it on their own. So the most important nudge that we can find is for people to get advice. Now that should mean that all the top 20%, all the high net worth, mass affluent people should be working with an advisor, and that's the most important nudge of all. The difficulty is that we end up with the mass market, who potentially may not be that attractive with RDR and other things, which I'm sure you've been talking about in terms of less advisors. And that's really where the money advice service and other things need to come in. And in a sense, there's still a lot more work to do, because I think we still need some form of a face-to-face way of getting people to do that. Now that, those of us who are involved in retirement seminars and whatever will know that they can be very powerful there. And that potentially, I think, is an area which I think it would be in the interest of government and others to support, is actually getting to the point where there are places where people can go to as they approach retirement to be given good advice. And maybe, again, if we go down the route of simplified advice, planners and whatever, there needs to be a way to be found there. Because getting people to understand that they need a plan, getting people to break down the myths that annuities are not as bad as they are, that actually they're very good. I think it's unfortunate that we have to try or that we do have to sell annuities to people with relatively small funds when they're in their early 60s and they're retiring. Because, in an ideal world, with people with enough money, they may delay and buy their annuities in their 70s. And once you start to buy an annuity in somebody in their 70s and 80s, you begin to see the effect of the cross-subsidy and the mortality credit and the yield, and it becomes an easier sale. So I think there are a number of issues that we still need to work our way through. But there's no doubt in David Blake and my mind is that the most important nudge is getting people to have a plan, ideally getting people to have a plan through an IFA.
Tom, thank you very much. I think there's no doubt at all that as the DC market matures, as people come through with more pots, there will be more scope to deliver these plans, and it's great to see that the science and the research is coming on a pace to match that need. Thank you very much.